Welcome to G Fun Facts Online. Today, we're diving into a quiet revolution happening in one of the world's largest economies. For generations in India, the safest place for your money was a fixed deposit, or FD. It was more than an investment. It was a cultural tradition, a financial heirloom passed down from grandparents. But that's changing. A new player, the Systematic Investment Plan, or SIP, is capturing the wallets and imaginations of millions. This isn't just a story about money. It's a fascinating look into human psychology, economics, and how we make decisions. We're going to explore the deep-seated reasons behind this massive shift, from the illusion of safety to the powerful forces driving a new era of investing. Let's start by understanding the institution that is the fixed deposit. To grasp the current shift, you have to appreciate the psychological fortress FDs built in the Indian psyche. For decades, it was the symbol of capital preservation. A survey by India's market regulator, SEBI, found a staggering 95% of households preferred FDs, with less than 10% even considering mutual funds or stocks. Why this loyalty? The primary reason is the promise of certainty. In a country with a history of economic volatility, a guaranteed return provides a powerful sense of security. It's a classic example of a behavioral economics principle called loss aversion. Nobel laureate Daniel Kahneman discovered that for most people, the pain of losing money is psychologically about twice as powerful as the pleasure of gaining it. An FD, by its very nature, shields you from ever seeing your investment value drop. It never shows a red mark in your portfolio. This, combined with government-backed insurance up to 5 lakh rupees, made it feel virtually risk-free. Another psychological advantage is simplicity. You deposit a lump sum for a fixed period and get a fixed interest. It's easy to understand, familiar, and trustworthy. But there's a crucial historical context we often forget. In the 1990s, FD rates were fantastic, sometimes soaring as high as 13%. They offer genuinely lucrative, safe returns. This creates a cognitive bias known as anchoring. Many people, especially from older generations, are anchored to the memory of these high rates. They continue to see FDs as a great investment, even though the reality today is drastically different. This brings us to the tipping point. What started eroding this decades-long preference? While the psychological comfort of FDs is strong, a harsh economic reality has begun to set in. The single biggest driver of this change is the declining real rate of return. The interest you earn on an FD is fully taxable. When you subtract taxes and then account for inflation, the rising cost of living, the actual purchasing power of your money often stagnates or even goes down. For example, if your FD gives you 7.5% interest, but inflation is also 7.5%, your real return is zero. Your money isn't actually growing. As one chartered accountant pointed out, 10 lakh rupees in an FD from 2010 might be 20 lakh today, but your essential expenses have grown 2 to 5 times in that same period. The safety of an FD is starting to look like an illusion. As FD returns dwindled, the performance of the stock market became a powerful magnet. This triggers another bias, recency bias. We tend to give more weight to recent events when making decisions. The Indian stock market's strong performance in recent years has created a powerful narrative of wealth creation. The Nifty 50 Total Return Index, for instance, has delivered an annualized return of over 14% since 1999. This recent history, widely reported in the media and discussed among friends, stands in stark contrast to the low returns from FDs. And when people see their friends and colleagues making money, another powerful force kicks in: herd mentality. The fear of missing out, or FOMO, is a huge driver of human behavior. The numbers are astounding. Annual SIP contributions in India nearly tripled in just 5 years, from around 1 lakh crore rupees to nearly 3 lakh crore. This SIP tsunami is a massive collective shift, driven partly by understanding the benefits, but significantly by the desire not to be left behind. So why SIPs? The shift isn't just about chasing higher returns. The very structure of a systematic investment plan is behaviorally smart. One of its most powerful features is rupee cost averaging. By investing a fixed amount regularly, say every month, you automatically buy more units of a mutual fund when the market is low and fewer units when it's high. This averages out your purchase cost and completely removes the stress of trying to time the market, something even professionals find nearly impossible. From a behavioral standpoint, this is a brilliant antidote to the emotional roller coaster of investing. It counters loss aversion. A market dip isn't just a loss. It's an opportunity to buy more units cheaply, which can lead to significant gains when the market recovers. SIPs are also the perfect vehicle for harnessing the incredible power of compounding, where your returns start earning their own returns. Linking a SIP to a long-term goal, like a child's education or retirement, provides a powerful motivational anchor to stay invested through market ups and downs. This also taps into a bias called mental accounting. We tend to put our money into different mental buckets. FDs are in the safe bucket. Equities are in the risky bucket. SIPs allow you to start adding small, regular amounts to your risky or growth bucket, without the fear of making a large, one-time bet. This gradual exposure helps overcome the initial fear associated with markets. This phenomenal growth wouldn't have been possible without the fintech revolution. Digital platforms have completely democratized investing. Before, investing in a mutual fund was a cumbersome process of paperwork and visits to a bank. Today, you can start a SIP with a few clicks on your smartphone. It's as easy as ordering food online. These fintech companies are also masters of using behavioral nudges, subtle prompts that guide you towards better financial habits. Things like notifications reminding you of an upcoming SIP, progress bars showing you how close you are to your goals, and automated debits make investing effortless and habitual. They've also made it incredibly affordable. Many platforms allow you to start a SIP with as little as 500 rupees a month, opening the doors of wealth creation to millions of young and small-ticket investors. All this has contributed to the rise of a new type of Indian investor. A concerted effort by regulators and financial influencers has increased financial literacy, demystifying the stock market. A significant portion of these new investors are tech-savvy millennials and Gen Z, who are more comfortable with digital platforms and more open to exploring new investment avenues. The number of demat accounts in India, which are needed for stock market investing, surged from about 4 crore in 2020 to over 20 crore by mid-2025, with huge growth coming from investors under 30. So what's the takeaway from this great Indian investment migration? While the shift to SIPs is a huge positive for long-term wealth creation, it's not a declaration of war on FDs. Fixed deposits still have a crucial role to play, especially for emergency funds, short-term goals, or for highly risk-averse people, like senior citizens who need a steady income. The ideal approach for most is a balanced one, combining the stability of FDs with the growth potential of SIPs. The allocation between the two depends on your age, risk tolerance, and financial goals. At its heart, this shift represents the evolution of the Indian investor, from a passive saver to an active participant in the country's growth story. Guided by a better understanding of markets and subtly nudged by technology, a new generation is learning to look beyond the illusion of safety, to embrace a more dynamic approach to building wealth. The age of the SIP has truly begun, not as a replacement, but as a powerful companion to the trusted FD in the journey towards financial well-being. Thanks for tuning in to G Fun Facts Online.